In 2013, Warren Buffett was offered a chance to buy shares in a rapidly growing tech company. The numbers looked incredible. Projected returns were stellar. Every analyst on Wall Street called it a smart move. Buffett said no, not because the decision was bad, but because it was merely good, and that's the problem most people never understand about how billionaires think. You see, when Jeff Bezos was asked why he walked away from a deal that had an 85% chance of doubling his money, he said something that confused everyone in the room. He said he was looking for decisions that didn't make sense to most people. Decisions where the upside was unlimited, even if the probability seemed worse. This isn't recklessness. It's a completely different mental framework. And once you see it, you can't unsee it. This video isn't about motivation. It's about the hidden psychology that separates people who accumulate wealth from people who build empires. We're going to break down asymmetric thinking, the cognitive framework that makes billionaires reject opportunities that would make most people rich and accept risks that would terrify most people. By the end, you'll understand why Elon Musk bet his entire fortune on two companies that were both likely to fail and why that wasn't crazy. It was calculated. Let's start with something most people get completely wrong about probability. When you hear that something has a 90% chance of success, your brain tells you that's a good bet. It's rational. It's safe. But here's what billionaires see that you don't. They're not asking about probability. They're asking about payoff structure. Because a 90% chance of making $10,000 is fundamentally different from a 10% chance of making $10 million. Same expected value mathematically. Completely different in reality. Warren Buffett has a mental model he calls the punch card theory. Imagine you only get 20 investment decisions in your entire life. 20 holes on a card. Once they're punched, you're done. No more chances. This single framework explains why he passes on deals that would make most investors wealthy. Because he's not optimizing for good returns. He's optimizing for extraordinary returns that only come from waiting for asymmetric opportunities. Here's the psychology behind this. Your brain evolved to avoid loss, not to maximize gain. When researchers study decision making under uncertainty, they find something fascinating. People feel the pain of losing $100 roughly twice as intensely as the pleasure of gaining $100. This is called loss aversion, and it's hardwired into your neural circuitry. It kept your ancestors alive, but it makes you poor. Billionaires have learned to reverse this instinct, not through willpower, through reframing. When Elon Musk was deciding whether to invest his PayPal earnings into SpaceX and Tesla, both companies had less than a 10% chance of survival according to industry experts. Most people saw this as a 90% chance of losing everything. Musk saw it differently. He saw a 10% chance of changing the world with unlimited upside if it worked. The asymmetry wasn't in the probability, it was in the payoff. Let me give you a concrete example of how this plays out in real decisions. In 2004, Jeff Bezos was approached by a startup that wanted Amazon to acquire their small recommendation engine. The technology was solid, the team was competent, the price was reasonable. Classic good decision. Bezos passed, not because it was bad, but because it was symmetrical. Small upside, small downside. Instead, he took the same capital and invested it in Amazon Web Services, which at the time seemed insane. An e-commerce company building infrastructure for other companies. The probability of success seemed low, but the upside was unbounded. Today, AWS generates more profit than Amazon's entire retail operation. This is what psychologists call expected value thinking, but billionaires take it further. They're looking for what Nassim Taleb calls convexity. Convex payoffs are situations where you benefit more from variance than you suffer from it. Think of it this way. If you invest $1 and the worst outcome is losing that dollar, but the best outcome is making $1,000, you have convexity. Your downside is capped. Your upside is open. Most people structure their entire lives to avoid convexity. They choose careers with predictable salaries, investments with steady returns, relationships with known outcomes. This feels safe, but it guarantees mediocrity because you can never capture the outlier events that create extraordinary results. Here's where it gets interesting. Billionaires don't just seek convexity in their investments. They structure their entire decision architecture around it. Take Peter Thiel's approach to startup investing. He doesn't look for companies that will probably succeed. He looks for companies that might fail, but if they succeed, they'll create a monopoly. He'd rather have 10 investments where 9 fail completely and 1 becomes Google than 10 investments that all return modest profits. The math works in his favor. But more importantly, the psychology works in his favor. Let me explain the psychology. When you make 10 good decisions that all work out moderately well, you feel smart. Your ego is satisfied. You get social validation, but you don't get wealthy. When you make 10 asymmetric bets where 9 fail and 1 explodes, you look stupid to everyone around you for years. You face criticism, doubt, social pressure to stop being reckless. This is why most people can't do it. Not because they don't understand the math, because they can't handle the psychology. Elon Musk talks about this openly. After selling PayPal, he had around $180 million. He put $100 million into SpaceX, $70 million into Tesla, and $10 million into SolarCity. He kept almost nothing for himself. When people called this insane, he said something revealing. He said he wasn't trying to make more money. He already had enough. He was trying to maximize the probability that the future would be good. Notice the reframe. He wasn't minimizing downside. He was maximizing upside for a completely different objective function. This connects to a decision framework that Jeff Bezos uses called regret minimization. But most people misunderstand it. They think it means avoid doing things you'll regret. That's not it at all. It means structure your decisions so that even if they fail, you won't regret trying. The psychology here is subtle but crucial. When you're 80 years old looking back, you don't regret the things that didn't work out. You regret the things you didn't attempt because you were afraid. Bezos used this framework when he left his high-paying job at a hedge fund to start Amazon. But the company had a 70% chance of failure. Classic bad decision by conventional metrics. But he ran the regret minimization framework. If he stayed at the hedge fund, made good money, had a safe career, would he regret not trying to build something? Absolutely. If he tried Amazon and it failed, would he regret the attempt? No, because at least he tried. The asymmetry wasn't in the financial outcome. It was in the emotional outcome. Now let's go deeper into something most people never consider. Second order thinking. When most people make decisions, they think about the immediate consequence. If I do this, what happens next? Billionaires think 2, 3, 4 steps ahead. And more importantly, they think about the consequences of consequences. This creates a completely different decision tree. Let me show you what I mean through a real example. In 1997, Reed Hastings got a $40 late fee from Blockbuster. Most people would think first order consequence is I need to return videos on time. Maybe second order is I should cancel my membership. Hastings thought differently. He asked, what are the systemic implications of a business model that punishes customers? What happens when technology makes video delivery cheaper? What happens when internet speeds increase? What happens when streaming becomes viable? He didn't just see a late fee. He saw the entire future of entertainment distribution. He founded Netflix. The psychology behind second order thinking relates to something called temporal discounting. Your brain heavily weights immediate consequences over distant consequences. If I told you that you could have $100 today or $150 in a year, most people take the 100 today, even though the delayed option is objectively better. This is why most people make first-order decisions. The immediate consequence feels more real than the cascading effects. Billionaires train themselves to override this instinct. Warren Buffett has a famous example. In the 1990s, he was criticized for not investing in tech stocks during the dot-com boom. Everyone else was making money. Buffett looked like a dinosaur. First order thinking said buy tech stocks, make money now. Second order thinking said if I don't understand the business model, I can't predict long-term value. If I can't predict long-term value, I'm gambling. If I'm gambling, I'm not investing. He sat out the entire bubble, lost short-term gains, avoided long-term catastrophe. When the crash came, he was positioned to buy incredible companies at bankruptcy prices. But here's what most people miss about second order thinking. It's not just about avoiding mistakes. It's about finding opportunities that don't exist yet. Let me explain through another real example. In 2008, during the financial crisis, everyone was panicking, stock market collapsing, companies failing. Conventional wisdom said protect your capital, preserve what you have. Warren Buffett did the opposite. He didn't just buy stocks. He structured deals with companies like Goldman Sachs and General Electric that gave him preferred shares with guaranteed dividends plus warrants to buy common stock later. Why? Because he was thinking second order. He knew that when fear is highest, you can structure asymmetric deals. He got downside protection through the preferred shares and dividends. But he also got unlimited upside through the warrants. The crisis created the opportunity. Second order thinking captured it. This connects to something called option thinking. And this is where asymmetric thinking becomes really powerful. An option is the right, but not the obligation, to take an action in the future. When you keep your options open, you preserve the ability to benefit from positive randomness without suffering from negative randomness. Billionaires structure their entire lives to create more options, not fewer. Let me show you what this looks like in practice. When Mark Zuckerberg was offered $1 billion for Facebook by Yahoo in 2006, everyone told him to take it. He was 22 years old. The offer was more money than he could spend in a lifetime. Classic good decision. He said no, not because he knew Facebook would be worth hundreds of billions. He didn't. But selling would eliminate all future optionality. Keeping the company preserved the option to sell later if things got worse, or to build something extraordinary if things got better. The asymmetry was obvious once you see it through the lens of options. The psychology here is fascinating. Most people hate uncertainty. When you have an option, there's uncertainty about the future. Your brain wants to resolve that uncertainty. This is why people take guaranteed money over uncertain potential. It feels like closure, like control, but you're trading optionality for certainty. And optionality is where all the value is in an uncertain world. Jeff Bezos has a principle he calls disagree and commit, but the way he uses it reveals deep asymmetric thinking. When his team wanted to build the Kindle, Bezos thought it was probably a bad idea. Reader market was crowded. Technology was expensive. Consumer demand was unclear. But he committed anyway. Why? Because if it failed, Amazon would lose some money but gain massive learning about hardware and digital content. If it succeeded, it would transform the publishing industry. Asymmetric payoff. The downside was capped. The upside was unbounded. Same framework. Different application. Now let me take you into something that will completely change how you see risk. Most people think billionaires are risk takers. They're not. They're risk mitigators who structure asymmetry. There's a concept in finance called the barbell strategy. Instead of putting all your resources in medium risk, medium reward activities, you split them. Put 90% in extremely safe, boring investments. Put 10% in extremely risky, high upside bets. The middle is a trap. The edges are where asymmetry lives. Nassim Taleb popularized this for investing, but billionaires use it for everything. Look at how Elon Musk runs his companies. Tesla and SpaceX are wildly ambitious, high-risk ventures, but he doesn't fund them with debt. He structures them with cash flow from safer ventures and strategic investors. He keeps personal expenses minimal, lives in a modest house, drives company cars. This isn't frugality, it's barbell strategy applied to lifestyle. Minimize downside in personal life, maximize upside in business ventures. The psychology behind this is about preserving optionality during failure. If you put everything in the middle, you can lose everything through slow erosion. If you barbell, your safe assets protect you while your risky bets have room to fail and iterate. Failure doesn't kill you, it teaches you. This is how Musk survived SpaceX's first 3 rocket failures. He had enough capital in safe buckets to keep trying until the 4th launch succeeded. But here's where most people completely misunderstand billionaire thinking. They think it's about taking big risks. It's not. It's about taking risks where the maximum downside is tolerable, but the maximum upside is transformational. Let me give you a precise example. When Warren Buffett bought Burlington Northern Santa Fe Railway for $44 billion in 2009, people called it boring, old economy, low growth, not exciting tech. But look at the asymmetry. Railroads are impossible to replicate. Geographic monopolies, pricing power, predictable cash flows. The downside, the business slowly declines, tolerable. The upside, it becomes even more valuable as truck transport gets expensive and rail becomes the carbon-efficient choice. The bet wasn't on growth, it was on durability with hidden upside. Classic asymmetric thinking. This reveals something crucial about how billionaires see the world. They're not optimizing for average outcomes. They're optimizing for tail outcomes. In a normal distribution, the tails are the extreme events, the outliers. Most people structure their lives to avoid tail risk on the downside. Billionaires structure their lives to capture tail risk on the upside. They want to be exposed to positive black swans, unexpected events that create massive gain. Here's a real example of this in action. Peter Thiel's investment in Facebook. In 2004, he put $500,000 into a college project run by a 20-year-old with no business experience. Insane by conventional standards. But look at the structure. Maximum downside, lose $500,000. tolerable for Thiel. Maximum upside, the company becomes the dominant social network, unbounded. The asymmetry made the bet obvious to him, even though the probability seemed low to everyone else. The cognitive bias that prevents most people from seeing these opportunities is called narrow framing. You look at each decision in isolation instead of as part of a portfolio. Thiel wasn't making one bet on Facebook. He was making hundreds of bets through Founders Fund. If 99 fail and one becomes Facebook, the portfolio wins massively. But each individual bet looked crazy to outsiders. This is why venture capital works for the people who understand asymmetry and destroys the people who don't. Let me now show you how this applies to something everyone faces: career decisions. Most people choose careers based on probability of success. They go into medicine or law or consulting because the path is clear. The outcomes are predictable. Good decisions by conventional metrics. But these are symmetrical decisions. Capped upside, your salary has a range. Your growth has a ceiling. You trade years for dollars on a relatively fixed rate. Now look at how billionaires structure career asymmetry. Before Elon Musk was Elon Musk, he was writing software. He could have taken a high-paying job at Microsoft. Guaranteed six-figure salary, prestige, security. Instead, he started Zippy2 with his brother. 70-hour weeks, no salary. High probability of failure. Why? Asymmetric payoff. If it failed, he'd be in his 20s with software skills. He could get a job anytime. Downside was capped. If it succeeded, he'd have wealth and freedom. Upside was unbounded. He sold Zippy2 for $300 million. The asymmetry paid off, but here's the deeper insight. The real asymmetry wasn't in the first company. It was in what the first success enabled. Once you have capital and freedom, you can make even more asymmetric bets. Musk took his Zippy2 money and started XCOM, which became PayPal. Sold that for $180 million. Then bet everything on SpaceX and Tesla. Each success created more optionality for bigger asymmetric bets. This is compound asymmetry, and it's how you go from comfortable to wealthy to billionaire. The psychological trap that stops most people is called sunk cost fallacy combined with status quo bias. Once you've invested time in a symmetrical path, you feel like you can't leave. You've put in 5 years toward partnership, 10 years toward tenure, 15 years toward pension. Walking away feels like waste. But that's backward-looking thinking. The question isn't what you've invested. The question is where the asymmetry is from this point forward. Jeff Bezos was on track to become the youngest senior vice president at D.E. Shaw Hedge Fund. That's a huge accomplishment, massive status, great money. Leaving threw away years of relationship building and positioning. But he asked the right question. From this point forward, where is the asymmetry? Staying at the hedge fund, capped upside, high probability. Starting Amazon, unbounded upside, low probability, but tolerable downside. He chose asymmetry. Now let me reveal something that will tie all of this together. The real reason billionaires avoid good decisions is because good decisions optimize for local maxima. They get you to the top of the hill you're currently climbing, but they prevent you from finding the mountain in the distance. In optimization theory, this is called the exploration versus exploitation trade-off. Exploitation means optimizing your current strategy. Exploration means searching for better strategies. Most people exploit too early. They find something that works and they optimize it to death. Billionaires stay in exploration mode longer. Warren Buffett could have stopped investing after his first 10 million. Could have optimized that wealth through safe bonds and enjoyed life. That's exploitation. Instead, he kept exploring new investment frameworks, found insurance companies as investment vehicles, found arbitrage opportunities, found category defining businesses. He stayed in exploration mode for 70 years, and each exploration created new asymmetries. The psychology behind this relates to what researchers call satisficing versus maximizing. Satisficers look for good enough. Maximizers look for the best possible. Most people satisfice because it's cognitively easier. Your brain doesn't like the uncertainty of continued searching. But maximizers, when they're searching for asymmetric opportunities rather than perfect ones, end up in completely different places. Here's the key distinction. Billionaires aren't perfectionist maximizers. They're asymmetry maximizers. They're not looking for the perfect decision. They're looking for the decision with the most asymmetric payoff. This is why they move fast once they identify asymmetry. Elon Musk is famous for making huge decisions in hours when most CEOs would deliberate for months. Not because he's reckless, because once you see clear asymmetry, speed is your friend. The downside of moving fast is you might fail quickly. The upside is you learn quickly and can iterate. Asymmetric again. Let me give you one final framework that brings everything together. Billionaires use what's called inversion thinking. Instead of asking how to succeed, they ask how to avoid failure. Instead of asking how to make money, they ask how to avoid losing money. This seems like the same question. It's not. When you invert, you see different risks. Warren Buffett has 2 rules of investing. Rule 1, never lose money. Rule 2, never forget Rule 1. This isn't about being conservative. It's about asymmetry. If you protect against total loss, you preserve the ability to capture upside. If you swing for home runs without protecting downside, one bad event wipes you out and you lose all future optionality. Look at how this played out in 2020. When the pandemic hit, many billionaires like Bill Ackman initially lost massive amounts. But they hadn't structured their portfolios to avoid all loss. They'd structured them to avoid permanent loss. They had dry powder, cash reserves. They could wait. When the panic peaked, they bought at the bottom. The temporary losses became permanent gains. The asymmetry was in the structure, not in being right about the pandemic. This is what most people never understand about billionaire psychology. It's not about being smarter. It's not about working harder. It's not about taking bigger risks. It's about seeing structure where others see randomness. It's about finding asymmetry where others see symmetry. It's about protecting downside while leaving upside open when everyone else is doing the opposite. The average person structures their life with capped upside and unbounded downside. They take safe jobs that can't make them rich, but can slowly impoverish them through inflation and stagnation. They avoid risks that could change everything because they're afraid of failure. They optimize for comfort in the short term and trap themselves in mediocrity long term. Billionaires do the exact inverse. They cap their downside through careful structure. They leave their upside unbounded through asymmetric bets. They embrace failure as the price of finding outlier success. Here's what this means for you. The next time you face a decision, don't ask if it's a good decision. Ask if it's an asymmetric decision. What's the worst that can happen? Is it tolerable? What's the best that can happen? Is it transformational? If you can tolerate the downside and the upside is unbounded, that's not a risk. That's an opportunity. And if everyone around you thinks you're crazy, you might be seeing asymmetry that they can't see. Because here's the thing nobody tells you. The decisions that make you wealthy aren't the ones that make sense to everyone. They're the ones that make sense only to you, only at that moment, with that specific combination of asymmetric structure. Warren Buffett's best investments looked foolish when he made them. Jeff Bezos' decision to start Amazon seemed insane. Elon Musk's bet on electric cars and rockets looked like suicide, but they all saw the same thing. Downside that was survivable, upside that was unlimited, and that asymmetry made the decisions obvious. So the next time someone offers you a good opportunity, pause. Ask yourself if you're optimizing for probability or for payoff structure. Ask if you're protecting against loss or capturing upside. Ask if you're making a decision that could change everything or a decision that will change nothing. Because billionaires don't avoid good decisions because they're contrarian. They avoid them because they're patient. They're waiting for the asymmetric decision, the one that doesn't make sense to anyone else. The one where the downside is a learning experience and the upside is generational wealth. That's not luck. That's not genius. That's just seeing the world as it actually is, a collection of asymmetric opportunities hiding in plain sight. The question is, are you looking?